Hello and welcome to the second episode of Mishra's Market View. In this video, we will talk about the inferiority complex in trading psychology because this is a very common issue that many traders face. So let's first start by defining what is meant by inferiority complex. Basically, this is a feeling of inadequacy and low self-esteem, which often leads to lack of confidence and hesitancy in making decisions. Inferiority complex can result from many factors, including your past experiences, your negative self-talk, and your self-comparisons to others. For traders, it can manifest as a fear of failure or a belief that they are not good enough to succeed in the market. Now, I told you 3 points: your past experience, your negative self-talk, and your self-comparison to others. Let's just bifurcate and dive deep into each of the three. Past experiences and how your past experiences may create an inferiority complex in the future. Let's just decode that. For example, there is a saying in the stock market that 90-90-90, which says that 90% of the trader lose 90% of their money in 90 days. Okay. So based on this, we all know that most of the people, which means 90% of the people, come ill prepared. They just want to earn money, quick bucks, basically a quick rich strategy. They think that is what the stock market is. They come and they will perhaps, if not, they will either wipe out their whole account. If not the whole account, then at least, as we said, 90% of their account within the next 90 days. So this scenario, this incident will be instilled in their heart in a subconscious mind that can they do it? Will they ever be able to be profitable in the market? And now individually also in their own personal life, many people have their own challenges, be it some family issue or personal issue or relationship issue, whatever it is, which will impact on their mental stability even more. Then once you have a negative past experience, then comes the next consequence of it, which is the negative self-talk. You suddenly you start labeling yourself certain things, that I am not a profitable trader, perhaps I am a loser, or perhaps it is not in my destiny to make that much of money that we are being shown in the social media. So such negative self-talks leads you or kind of force you to compare yourself with the other parties. Other parties in the meaning, what I meant by other party is that the people who are, let's say, credible people who are posting their big profits on social media in order to inspire people. That's what they think. So when you see that big traders are earning 40 lakh rupees a day, or in a single trade, 50 lakh rupees a single trade, or perhaps let's turn down the notch a bit, perhaps 2 to 3 lakh rupees per trade or perhaps per day. And here you are saying that I am losing 3,000 rupees, 4,000 rupees, or perhaps 15 to 30,000 rupees per day without seeing any kind of profits. So this self-comparison tells you that how shallow you are or how small of a thing you are in such a big market. And this happens, perhaps if not consciously, then subconsciously, eventually it will happen to you. If this is your condition, if you have been through this also, perhaps I have also been through that. It's not that this thing is new to me. The very thing that I'm able to explain this to you in a crystal clear manner, because I have gone through this phase. But it's, let's call it luck, or let's call it destiny, that I was able to pick myself up in a very short period of time without wasting much of the time and money in overthinking, rather than just sticking to the strategy or your discipline, whatever you may be having with you. So what happens? Trader with an inferiority complex may hesitate to take risks or make trades, which can result in missed opportunity or losses. They may also second guess their decisions, which is nothing but analysis paralysis about the missed opportunity. So let's just understand this point. Hesitation in taking trades or making a trade is one of the biggest mistakes that most of the people do, because they are afraid. They are not confident about their analysis. They are not confident about their setup. And perhaps they are not confident about their caliber of being a good trader. They just want that if I start from here, I just want to see profits for the next 1 month or next 2 months, or perhaps I want to see profits for the next every single day till next 100 days at least. But that is some unrealistic expectation. You have a bad past experiences, even if you study well, and even if you prepare yourself and come back to the market. But if you don't, clear the clouds inside your head, perhaps there is a high probability that you may again end up losing money or end up delivering a bad performance, because it is inside the mind. Because you thought that, okay, my analysis is this, as per this analysis the market is supposed to behave in this certain way, and if it does, I will enter in this level, or I will basically you will identify a point of entry and a point of exit. Because of your bad past experiences or whatever your negative experience you had in your history, you may second guess that, you may have second thoughts that what if this I lose again. So your thought process is not on making the accurate entry or making the accurate decision, but it is that I don't want to lose money. And this is a difference between people who are very much comfortable in the mindset and people who are not very much comfortable in the mindset. When I make a trade, I personally, I'm talking about me, when I make a trade, all I see is that I want my setup and I want my decisions to be correct. Because as every trader knows that your risk must be defined. I know my risk is defined. Up to some extent, that loss is very much acceptable to me. But the point is, now I do not think about losses at the time of entry. There is a kind of anxiousness, there is a kind of nervousness, perhaps, yeah, you can say that, but it is such situation where you have to train your mind not to think about the losses or not to think about the profits. Because eventually two things will happen. Either you will miss the opportunity, which will end up where you will end up with FOMO, fear of missing out. And due to fear of missing out, you may enter a trade which is not worth entering, because you assumed that perhaps perhaps there is a loss of opportunity if I don't enter, so let us just enter and let me just take some profits. This is not a tactical decision, and this is not a strategic way to trade in the stock market, which is so volatile and so dynamic in nature. You need a proper risk plan. Or the other scenario, other than FOMO and missed opportunity, the other would be a loss. You second guessed it, you entered late, or perhaps you eventually entered in an inaccurate manner, which will eventually give you losses in the long run. Perhaps you may have some profits here and there due to luck, but as a professional trader, you will definitely, professional in the sense, as a proper trader for a long run, you will eventually end up losing money if you have such kind of a personality while trading. So the solution to this is that there is a pre-market analysis. Before the market opens, we go to the higher time frame. We we check out the Nifty, we check out Bank Nifty, we check out the American markets, the Dow Jones, the Nasdaqs. How are they performing? Because we all know that the smart money, which is the FIIs, foreign institutional investors, everything is interlinked and everything is having influence over each other. Perhaps the global indices have more effects on our Indian markets. So before the markets, analyze what is happening in the globe. Because the global market like US, Europe, Nasdaq, NYSE, FTSE, they are all quite powerful stock indices than ours. So if something happened there is a high chance that we might face the effects in our market. Then you analyze our own independent markets. Like if you want to trade Bank Nifty, look out the charts, draw some levels, and most importantly, look into the factors of that index. Bank Nifty is composed of different kind of different stocks of banks: HDFC, ICICI, Axis Bank, whatever else is there. We all know there is a weightage. HDFC holds this much of weightage, ICICI holds this much of weightage, Axis holds this much of weightage. Perhaps these three are the most important stock in the Nifty Bank, which hold the highest of the value. So look at their behavior. Do some analysis in order to move the car, you must have the engine's connection proper. Otherwise, you may think that the car look nice, there is it's a great color, all the tires are there, the steering is there, but the car is not moving because perhaps the small connection of your clutch or perhaps of the engine is not there. What I mean to say by this example is that even your smallest of effort, your smallest of understanding of the market matters. If you think just looking at the chart, just drawing a support and resistance, just drawing a trend line, if this is what trading means, that then it is it would be foolish of you to think like that you can make a long money in the long term. And there is also one thing, that a strategy, the higher its popularity, the lesser its effects. Because if everybody learns that the same strategy, and if everybody tries to apply the same concept, then it won't work, because the market needs someone to fail. And if everybody thinks that this is the resistance, and if the market crosses this level, it will just shoot up. And if everybody thinks that everybody start buying, who will sell? So it is simple, but it is not that easy that you just understand some bookish knowledge of few pages, you just draw some lines. It does work, but it requires multiple of minor factors. A very professional trader and a good trader, the only difference is the minor factual. He understands the deepest, the minutest components of the markets. That's how he is able to protect himself from the unnecessary losses that other traders might not be able to do that. So in such a way, you can analyze what is your view of the market, what is your view of, do a pre-market analysis, do a post-market analysis. And because while the market is on, the market is live and active, you have your own setup where you can do some live analysis. That is fine, because live analysis will require some experience. In order to get accurate in live market, you need some experience. So have your own view. So what can we do in order to overcome this inferiority complex? To overcome an inferiority complex in trading, it is important to recognize the negative self-talk and beliefs that are holding you back. This can involve changing your mindset and focusing on your strengths rather than on your weaknesses. And I'm not saying that this is because trading is so much about psychology. Everybody knows that all the technical indicators, all the strategies, all the charts and everything, the whole umbrella of technical work is only 20 to 30%. The rest of the thing in a trader's journey is all psychological. It's mindset. So even if you work on the psychology part, even if you, let's say you somehow mastered over a period of time the 80% of your journey, trust me, even with the simplest of strategy, you will be able to make good returns, and that's all you want. Most of the people are unable to do so because they are in the search of a holy grail. They want the strategy which is the most exclusive, the most rewarding, with zero risk. And if you are mature enough, you know that these three things will never come together. So what I'm trying to say is that you have to be practical. A point where you become motivation, inspiration, you're getting inspiration from other big traders, that is fine, that is well enough, it is good to start, it is healthy. But when it comes to your own money, you have to be practical with your own analysis. At least lose money because your analysis did not work. Don't lose money because it was a fluke. There is a difference with that. Even if I have a strategy, it may fail. But when it fails, I am perfectly confident because my strategy, if it works like 60 to 70%, I know that 30 to 40% of the time it has a chance to fail. So I am losing money because I lost the trade because of the inefficiency of my strategy, not because I just took some random trade. That's how I differentiate between gambling and a professional trading journey. So focus on your psychology. Whatever experiences you have in your past, in terms of your trading journey, whether you have some good profits or big losses, most of the people will definitely have some losses. This is because this is This is universal rule. You will have to go through this phase. So treat that it's normal, but only if the loss is under your control. I am not saying that watching this video or some other psychological video or other some strategic video will suddenly start making money. Absolutely no. But what will happen? How can you improve? Your next step should be, it is evident and it is guaranteed that you're going to make some losses in your coming time. But make sure that your losses are under your control. Maybe you're not that skilled enough to make money right now, but please be mature enough to give a certain amount of loss. For example, let's say you decide that I will give only one loss. I will have, let's say, two losses and a combined value of, let's say, 1,000 rupees. So eventually you will divide that every trade I may risk 500 rupees. And if I don't have to lose 1,000 rupees in a single day, that means, and if in one trade I'm losing 500, I'm willing to lose 500, that eventually gives me only two trades. So one thing is clear, that you will only lose 1,000 rupees this day. And this certainty, trust me, in the long run, if you do follow this kind of setups, this kind of a certainty now will help you, and suddenly instead of focusing on the losses, you will suddenly start developing and you will suddenly start focusing on your setup accuracy and the technicality of the components of the index. This is how you take step-by-step action. Certainty. You know that market is uncertain, then whatever is in your hands, make it certain. How much profit you will have, perhaps nobody knows. 1:1, 1:2, 1:3, 1:4, 1:5, whatever the ratio, the reward ratio could be. It could be 4 times, 5 times, 6 times. But one thing is clear, that I'm not going to lose more than 1% of my capital, or perhaps, let's say, if you're a little more experienced, you can trade up to 3% of your capital. But that is it. If, let's say, by chance something happens in just single trade, I am able to lose 1,000 rupees, or I hit my 3% mark, just close. Don't feel bad that, oh my god, I hit my stop loss, but the market is still moving, someone is still making money. You will assume that, after the market closes, the big players are going to post their big profits, and I will feel jealous, or I will feel insecure, or perhaps you will have a feeling of FOMO, fear of missing out. You missed out on the opportunity, but that is fine. You control that, because the market is always there, except Saturday and Sunday. So additionally, what can you do? Additionally, developing a solid trading plan. Sticking to your strategy can help you build confidence and trust in your abilities. Practice a good risk management and learn from your mistakes as much as possible. So let's talk about the solid trading plan. How do I develop trading plan if I don't watch YouTube videos? Do watch some YouTube videos, that is fine. Perhaps in some upcoming videos, I may recommend some free content on the YouTube that is actually beneficial to you. Read books. In upcoming videos, I will definitely recommend you some books, but some of the all-star books is that Trading in the Zone, Super Trader, a Day in the Life of a Day Trader. These are few books which are like by default you are supposed to read. And in order to understand the concept of money, you can even try read the psychology of money, because it may not be directly related to trading, but it deals with money, and money is what makes stock market. So you can read that also. But I will make a dedicated video on the recommended videos, recommended books, the resources that can be useful for you guys. So let's skip that. Stick to your trading plan, do some analysis, and the most important thing, the only homework a trader can do is back testing. I will release a dedicated video about back testing, its value, and how to actually do it. But for example, that I have a law degree. As a lawyer, the only way a lawyer can organically grow is going through the books. He has to dive into the bare acts. He has to read the bare acts, read the sections over and over again with different scenarios, so that his maturity as a lawyer improves. So how can we improve our maturity? It's not that I only have to lose money in order to increase my maturity. No, that is also wrong. What you can do is, we have a software called tradingview.com. Everybody knows that. Everybody have their own broker's account. Open a chart. Go to whatever strategy you think fit, or you may think it is interesting. It is fine, not, and it is completely normal not to have a strategy in the first initial time, because you need to develop it. And during those periods, if you stumble upon 100 strategies, try it. But how will you try it? Don't try it directly in the live market. That is a foolish approach. If you found a new strategist, directly you are going in the live market and trying it out, that is foolish. You can try out whatever strategy you want, whatever fancy indicators you want, but go and backtest with at least 100 to 200 charts. 200 days of charts. Because that is your homework. And we have data like many years. Go back as long as you can, at least, and mark my word, I'm talking about at least 100 days, 200 days, go behind day by day, day by day, day by day. You will suddenly realize the variation of the variety of movements market made in the last 100 days. You will understand that whether this strategy is for you or not, or perhaps even if it is a profitable strategy, whether this suits you or not. You will definitely, in the end, it is the reality. You will understand how to develop it. So don't hurry, don't rush. Second is, if you develop a strategy, if you develop a trading plan, rule number 2, a very simple rule, but very difficult to follow, that is, stick to it. If I made a plan and if I have rules, no matter what happens in the market, I will only stick to my rules, and only if market follows my rule, I will trade. That is nothing but discipline. We all say, be disciplined, be this, be that, be disciplined, be have some risk management rules. Eventually, these are the simple things. I have my rules, and only if market follows my rules and market behaves in my way, in the way that I have mentioned in the rules, then only I will be able to enter the market. Otherwise, no. If the market is moving without the conditions being fulfilled, let it move. Don't go on the volume, or that you have to trade. Day trading or intraday trading does not mean that you are mandated. You have a compulsion to trade every day. No, day trading simply means you buy and exit on the same day, but with quality, but with logic. This is the perception you have to build over the period of time. So moving on, and if you do this, have a solid trading plan, stick to your plan, and only when market behaves as per your trading strategy or your discipline, you enter the trade. This will build your confidence slowly, because now your focus is on whether my strategy will work or not. Loss, as we discussed earlier, is sorted. Not more than 1%, 2%, 3%, whatever as per your capability and as per your experience. If you're a beginner, start with 1%. If you're a little seasoned, you may risk 3%. But you get the point I'm trying to say. So shift your focus from money to the actual journey, which is nothing but building a strategy, building your personality, and building your confidence. And confidence in what? In your own trading strategy and in your decision-making ability. If you do this over the period of time, as we say, the 90-90 rule, 90% of the people lose 90% of their money in 90 days. If you cross that threshold with such discipline, there is a high probability that you may end up becoming a very good trader. So overall, overcoming an inferiority complex in trading requires a combination of mindset changes, skill building, and self-reflection. And if you address these issues, there is a high probability that you will become successful and a confident trader. So I hope you like this video, and see you in the next video. So stay tuned.